Imagine it's a Sunday night. You're scrolling on your phone and you remember that crypto you bought a couple of years back, the bit you sold, the coin you swapped for another, the time you cashed out, and a quiet question lands. Did you ever actually report any of that? Here's the part most people miss. The ATO already runs a data matching program that covers every registered Australian exchange. So, that small swap you'd half forgotten, if it flowed through an Australian platform, it can still be visible. Today, I'm going to show you exactly what you need to declare and how to do it before you lodge. If you've never been told how crypto is actually taxed, that's not a failure on your part. Most people in your position have never been walked through it once. So before you lodge your next return, there are 3 moves I want you to make. Check the tax treatment of every transaction, reconcile your exchange history against the ATO's records, and estimate your real gain under the capital gains tax rules. Get these wrong and you don't just owe tax, you risk penalties and interest stacking on top. Let me show you the number that makes this click. Here's the number that surprises people. Your crypto gains can be taxed anywhere from 0 to 45% at your marginal income tax rate, not some flat crypto rate according to CoinJar's 2026 guide. But here's the part nobody tells you, and this is genuinely an Australian advantage. If you hold an asset for at least 12 months, a 50% CGT discount can halve your taxable gain. Miss that window, and you're taxed on the full amount. So timing isn't a small detail. It can literally double what you owe. So here's your plan. 3 moves. Check your treatment. Reconcile your history. Estimate your gain. Each one takes you under 20 minutes, and they're all completely free. Let's start with the move almost everyone gets wrong. Move 1 starts with a mistake almost everyone makes. And if you've made it, you're in very good company. Most people treat every crypto disposal as a simple swap. No harm, no tax. But the ATO treats many disposals as capital gains tax events. Selling, swapping one coin for another, gifting it, even using crypto to buy goods and services. The ATO, the body that runs Australia's tax system, values each disposal in Australian dollars at the moment it happens. That AUD value, not what you originally paid, is what triggers your gain. And here's where the timing really starts to bite. The impact is bigger than you'd expect. Because your gain is taxed at your marginal rate up to 45%, the holding period matters enormously per CoinJar's 2026 guide. Say you make a $10,000 gain, hold the asset 12 months or more, and the 50% CGT discount means only $5,000 is taxable according to CoinLedger. But sell too early, under 12 months, and the full $10,000 is taxed. Same gain, double the taxable amount just because of timing. If you're a smaller holder, that might be a few $100s. If you've had a bigger run, it could be thousands. Now the second layer, and this is the one people underestimate most. It's not just how your crypto is taxed, it's how visible it already is. The ATO runs an active data matching program and says it can collect exchange account and transaction information to identify crypto users who haven't reported correctly, according to its own policy page. This work ties into the incoming OECD Crypto Asset Reporting Framework, or CARF, with the ATO flagging the 1st of January 2027 as the proposed start date. So this isn't a future problem, it's already running. Here's why fixing this now matters so much. The cost of doing nothing isn't just tax on one missed gain, it's exposure compounding across multiple years per the ATO's data matching program. Because the tax base is each taxable event, not just your final cash out, one missed reporting cycle can snowball. If you've traded year after year, you could end up with several corrected assessments at once, according to CoinJar's 2026 guide. The cheap time to fix this is now, while it's a quiet tidy up, not a back-year scramble. Here's the myth that catches the most people, and you may believe it right now. The belief: crypto-to-crypto swaps are tax-free because no cash was received. The fact, straight from the ATO's crypto guidance, many swaps are CGT events, so swapping one token for another can still create a taxable gain or loss measured in Australian dollars. No cash needed. Now, let me be honest with you about something most guides skip over. I want to be upfront with you here because not every disposal is a tax bill. If your crypto actually went down in value, that swap or sale can be a capital loss and losses can offset your gains, which is genuinely in your favor. But on the gains side, the maths is real. Lose the 50% discount on a $10,000 gain and you're taxed on $5,000 more, per CoinJar's 2026 guide. Stack that across 2 years of ignored disposals. Say two $14,000 gains taxed without the discount, and the extra tax can easily top $4,000 on a conservative estimate, and that's before any penalties or interest. Let me show you what this looks like for a real person, because it makes the whole thing concrete. Meet Mia. She's 34, a marketing manager earning $92,000 a year. She holds a $38,000 crypto portfolio, mostly Bitcoin and Ethereum, on a major Australian exchange, and she's about 9 years from her retirement plans. She thought her crypto was simple. Here's what she actually found. Her first discovery, a $14,000 total gain. Mia assumed that was just crypto profit, money that was hers, free and clear. But it's a tax event, taxed at her marginal rate according to CoinJar's 2026 guide. Here's the good news though. If she qualifies for the 12-month holding rule, only $7,000 may be taxable instead of the full $14,000. Timing alone changes what she owes, and her next discovery is the one most people never see coming. Her second discovery hit harder. Last year she rebalanced her portfolio, sold one coin to buy another, never touched a single Australian dollar. She assumed that was free. But selling one coin for another is a CGT event per the ATO's crypto guidance, so her rebalance created a taxable gain despite zero cash changing hands. If you've ever shuffled your holdings around, this one's worth pausing on. Her third discovery was the one that genuinely worried her. The ATO may already have her exchange data, her account activity going back years. Australian exchanges have reported to the ATO since 2018 according to the ATO and coin tracking, so those trades she never reported aren't invisible. They can be matched against her return. The reassuring part, knowing this now, means she can get ahead of it instead of waiting for a letter. Add it up for Mia. Two $14,000 gains, taxed without the 50% discount at a mid-bracket rate. That's over $4,000 in extra tax on just those two gains, on a conservative estimate using CoinJar's 2026 figures. And again, that's before penalties or interest. Now let's work out whether any of this applies to you. So could this be you? 3 quick signs. You've swapped one coin for another and never reported it. You don't actually know how long you've held each asset, or you've never matched your exchange history against your tax records. If any of those sound like you, and for most people at least one does, the next 3 moves are exactly what you need. Here's the good news. You don't need to overhaul your whole financial life. You just need 3 specific, practical steps you can start today. 3 moves. Let's do them together. Move 1. Check the tax treatment of every transaction. Log into MyGov, open ATO online services, and use the Crypto Asset Investments guidance to classify each transaction. Was it a disposal, an income event, or a personal use purchase? Then match every disposal date to its Australian dollar market value and how long you held it. Just so we're clear, this is general information, not personal tax advice. Your own circumstances matter. Here are your 3 steps. 1. Log into MyGov and open ATO online services. 2. Use the Crypto Asset Investments guidance to classify each transaction. 3. Match every disposal date to its AUD value and holding period. You'll know you've nailed it when every gain and loss is tagged correctly, with your 12-month holdings clearly flagged for the discount. Move 2. Reconcile your exchange history against the ATO's records. Download statements from every exchange and wallet you've ever used, then compare them with your own tax records. Match every deposit, swap, sell, and withdrawal line by line, and flag anything missing in Australian dollar value, plus any transfers and airdrops for a closer look. This is the step that catches the trades you'd genuinely forgotten about. Your 3 steps here. 1. Export transaction histories from each exchange and wallet. 2. Match deposits, swaps, sells, and withdrawals line by line. 3. Flag missing AUD values, transfers, and airdrops. You'll know it's done when there are no unexplained balance changes, and every taxable event is tied to a source record you can point to. Move 3. Estimate your real taxable gain before you lodge, using the ATO's rules for crypto as a CGT asset. Separate the assets you've held under 12 months from those you've held longer. Calculate each gain in Australian dollars at acquisition and disposal. Then apply the 50% discount only where the holding period rule is actually met. Getting the split right is what keeps you from over or underpaying. 3 steps to finish. 1. Separate assets held under 12 months from those held longer. 2. Calculate gains in AUD at acquisition and disposal. 3. Apply the 50% discount only where the 12-month rule is met. You'll know it's right when your discounted and undiscounted gains are split cleanly. No guesswork on your final tax position. Why does now matter so much? Look at the timeline. Back in 2018, Australian centralised exchanges were already obligated to report to the ATO. In 2024, the ATO announced an expanded data matching program pulling trading and personal information directly from platforms, per its policy page. And looking ahead, the ATO lists the 1st of January 2027 as the proposed start date for OECD CARF and domestic reporting. One honest caveat: the 2026 and 27 thresholds and that 2027 date can shift in future budgets, so it's worth rechecking them before you rely on them. Once you've done the moves, here's how to check your own work. You should see every disposal tagged with an Australian dollar value and a date. Confirm that your records match your exchange exports exactly. No gaps anywhere. And if a gain came from an asset you held 12 months or more, the 50% discount should be applied. If anything about your own situation feels unclear, that's exactly the moment to speak to a registered tax agent. Everything I've shown you here comes from the ATO's own crypto guidance and policy pages, plus the 2026 tax guides from CoinJar and SwiftX. All the links are below if you want to read them yourself. So if you've made it this far, you now know something most crypto holders don't. Your disposals are CGT events, the ATO can already see them, and 3 simple moves get you compliant before you lodge. Your next step is to export your exchange history tonight. It takes about 10 minutes. If you want to understand exactly how the ATO's data matching finds undeclared income, that's what we dig into next. You came in worried about a surprise tax bill, and you're leaving with a clear plan you can act on today. That's the whole point. I'm Sophie. I'll see you in the next one.